The Sensex just crashed 3,000 points in a single day. Your phone is buzzing, your portfolio is red, and everyone around you is saying the same thing. Stop your SIP, get out, save whatever is left. But what if that advice is the worst thing you could do right now? What if the people who stop their SIP during a crash are the ones who stay poor, and the people who keep investing are the ones who build real wealth? Stay with me for the next 8 minutes, because I'm going to show you the math, the history, and the exact steps you need to take right now during this crash. Welcome to Built to Hold, where we build wealth the right way. Slow, steady, and smart. Let's get into it. First, let's understand what is actually happening, because most people are panicking without even knowing why the market is falling. Here's the chain reaction, and it's simpler than you think. The United States imposed new tariffs on global imports. That created uncertainty in world markets. Foreign institutional investors, the big money players, they got nervous. And when big money gets nervous, it leaves. FIIs started pulling their money out of Indian markets. Billions of dollars. Gone. And when that much money exits, the Sensex falls. The Nifty falls. Your portfolio falls. This is not some mysterious crash. This is cause and effect. U.S. tariffs leads to global uncertainty, leads to FII selling, leads to Indian markets fall. That's it. That is the whole story. Now here's the part no one is telling you. This is not the first time. Let me show you something. In the year 2000, the dot-com crash wiped out markets worldwide. People panicked. People sold. And then, the market recovered. 2008, the global financial crisis. The worst crash in modern history. People said the economy was finished. And then the market recovered. 2020, COVID hit. Markets fell 40% in weeks. Panic everywhere. People stopped SIPs, they sold their funds, and then the market recovered. Again. And now, 2026, tariff war, markets falling, people panicking. Do you see the pattern? Every single crash in the last 26 years has been followed by a full recovery. Every single one. So the question is not, will the market recover? The question is, will you still be invested when it does? Let me make this real with actual numbers. It's 2008. The market has crashed. 2 investors, same age, same income, same SIP amount of 5,000 rupees per month. Investor A panics, stops the SIP, waits for things to settle. Investor B stays calm, keeps the SIP running every single month. 10 years later, Investor A has 3.7 lakh rupees. Investor B has 12.4 lakh rupees. Plus. Same person, same money, same time period. The only difference was one decision, made during a crash. Now let me show you why continuing your SIP during a crash is actually powerful. This is called Rupee cost averaging. And most people have heard this term, but they don't feel it. So let me show you the actual math. Imagine your SIP invests 5,000 rupees every month into a mutual fund. In January, the market is normal. The NAV, the price per unit, is 100 rupees. So your 5,000 buys you 50 units. In February, the market crashes. NAV drops to 50 rupees. Your same 5,000 rupees now buys you 100 units. In March, market starts recovering. NAV is at 75 rupees. Your 5,000 buys 66 units. 3 months, same 5,000 rupees every month. Total units bought, 216 units. 3 months, same money, 216 total units versus just 50 units if you had stopped in February. Do you see what just happened? The crash gave you more units for the same money. A market crash is not a disaster for a SIP investor. A market crash is a 50% discount sale on wealth creation. Think about it this way. If your favorite phone, worth 50,000 rupees, was suddenly available for 25,000 baht, would you say, no, I'll wait until the price goes back up? No, you'd buy it right now at the discount. Stocks work the same way. Let me show you the direct comparison. Two investors, same SIP, same fund. One stopped the SIP during the crash, one continued. After the recovery, the investor who stopped came back at a cost of 11,600 rupees per unit, but the investor who continued averaged around 21,600 per unit. Same fund, same time. One person paid full price, the other got a discount. That difference compounded over 10 years is the difference between a good portfolio and a great one. Before I move forward, I want to ask you something. Have you ever stopped your SIP during a market fall? Drop it in the comments below. Just say, yes, I stopped, or no, I stayed. Your answer might actually help someone else watching this video right now. Okay, let's keep going. In every market crash, there are 3 types of investors. Type 1. The panicker. This person sees the red portfolio, gets scared, stops the SIP, maybe even sells their existing units, and then waits and waits until the market feels safe again. By the time they come back, they've missed the best buying window. They come back at higher prices, and their 10-year wealth? Significantly lower. Type 2. The pauser. This person doesn't sell, but they pause the SIP. Let me just wait a few months and see what happens. Sounds reasonable, right? But here's the problem. No one knows when the recovery starts. The best months for rupee cost averaging are the months during the crash. When you pause, you miss exactly those months. After 10 years, the pauser does better than the panicker, but significantly worse than... Type 3. The builder. This person looks at a falling market and says, this is not a loss, this is a discount. They don't stop, they don't pause, they keep investing, every month, consistently. And after 10 years, the builder has wealth that is 60% more what the panicker has. Built to hold is about being the builder, every time. Let me give you the exact numbers. Same SIP, 5,000 rupees per month, same fund, 10 years. The panicker, who sold in fear and came back late, ends up with just 7.2 lakh rupees. The pauser, who stopped and waited, ends up with 8.9 lakh. The builder, who continued and increased their SYP, ends up with 11.6 lakh rupees. Same money, same time period, 4 lakh rupees difference. That is the cost of panic. That is the price of fear. Okay, so now you know the why. Let me give you the what. Here is your 5-point crash action plan. Write this down. Point 1. Do not stop your SIP. Not even for 1 month. The best units you will ever buy are the ones you buy during a crash. Protect this habit like it is your most valuable asset, because it is. Point 2. Do not sell in panic. Selling during a crash means you lock in your losses. The market will recover, but only those who stayed invested will benefit from that recovery. Point 3. Set a crash calendar reminder. Write today's date. Set a reminder for 1 year from now. Then open your portfolio then. You will thank yourself. Point 4. Increase your SIP if possible. Even a small top-up, 500 or 1,000 rupees extra during this crash window can significantly boost your long-term returns. The discount is open. Use it. Point 5. Turn off financial news. Seriously. The news is designed to make you feel panic, because panic gets clicks. Your wealth does not grow from watching panic. It grows from ignoring it. The market does not care about your emotions. It only rewards your patience. Markets fall. Patient investors build. If this video gave you clarity, if it stopped you from making a decision you would regret, then please share it with one person in your life who needs to hear this right now. And if you haven't already, subscribe to Built to Hold, because every week, we break down exactly how to build real long-term wealth with clarity, with data, and without the hype. Stay invested, stay consistent. This is Built to Hold.